Faculty of Finance. I'm working in DDE. I'm going to take accounting for manager paper, right? Some of you may have studied BCom already. You may have studied basics in accounting for managers. Many of them come from science background or engineering background. They do not have any basic knowledge. So I wanted to start from beginning. What is the basic? What is the journal entry? What is the thing? From basic onwards, I am going to teach. Your accounting manager paper covers three accounting papers. One is financial accounting, the basic accounting, preparation of final accounting statements, all these things. Then cost accounting, cost sheet, marginal costing, all this standard costing, these things you are going to study. And some of the units from management accounting, that is ratio analysis, fund flow, cash flow, all these things are basic accounting knowledge. One manager should have all these knowledges, right? So that's why the syllabus is framed like that. But your examination point of view, 80 percentage problem oriented, 20 percentage only theory oriented, right? So you know very well, 75 percentage for external mark, 25 percentage for internal mark. For internal mark, that is one word questions, will multiple choice questions will be asked. For 75 marks, it will be part A, part B, and part C. Okay. In part A, that is 4 marks question, 5 questions you have to answer. Part B, 8 marks question, you have to answer 5 questions. Part C, 15 marks. Okay. Wait a minute, I will add PPT. Can you see this PPT?
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
This is the paper accounting for manager in first semester you have. Can you say anybody what is accounting? Accounting means what? What is accounting? Many of you may have studied BCom. BCom students, can you say what is accounting?
To keep an account of something, ma'am. Especially
Accounting?
when we
Uh,
Keeping a record of transactions, ma'am.
Keeping a record of only for keeping. That is called bookkeeping. Only recording in transactions in the books, that is called bookkeeping. That is the beginning stage of accounting. First stage of accounting. Then is it completed only for recording the transaction?
Also important, ma'am. Analysis part.
Using the information for P&L.
Yes, that's why, see here, accounting definition itself explain you the total what you are going to do. See here, accounting is art of recording. Recording means all the business transactions recorded in the books. First book, that is called journal entry, that is bookkeeping. We used to say it is a bookkeeping, right? After recording the transaction, you have to classify under various heads. What is cash? What is X account? What is Y account? What is creditor? What is sales? What is purchases? So every month end you have to come to know how much purchases have been done, how much we have to pay for creditor, how much we have to collect it from debtor. So all these informations you need, right? So for that we have to classify the transactions, that is accounts individually. That is called ledger accounting. After preparing journal entry, you have to prepare ledger account, that is classifying the transactions what you have recorded, right? And summarizing. What do you mean summarizing means what? What is summarizing? When you are preparing ledger accounts, you may have either debit balances or credit balances. So the ledger balances of debit and credit balances you have to bring into one statement, that is called trial balance. Trial balance that depicts the you know very well accounting equation. All the debit transactions are equal to its credit transaction. That is the accounting equation. That means all the capital and liabilities are equivalent to your assets. That is accounting equation, right? So in this case, when you are bringing all the debit balances and credit balances of your ledger accounts into one statement, that should be tally. If trial balance is not tally, or it is giving debit side one balance, credit side one balance, that means error. You might have committed some error. So that is the trial balance is preparing for the purpose of arithmetical accuracy of transaction what you have recorded in the books of account. Then all these things you are recording in terms of money or money's worth, right? Significant manner. That means you have to record systematically. You have to follow the principles of accounting principles. All these things you have to follow. Then the transactions and the events which are in part, why we are preparing for the purpose of to know the result of preparing final account. What is the result? Whether to earn profit or loss. So what is the account assets balance? What is the liabilities balance? You should know, right? So all the transactions should be in financial character. If it is in qualitative, we cannot record it. So only all these transactions should be a financial character, and you have to record, classify, summarize in the terms of money, and all the events you have to record in the financial character, and you have to, it is preparing for the purpose of finding the profit or loss, right? So that is called accounting. Accounting definition itself explain you what you are going to do, entire thing, right? Bookkeeping is here only recording the transaction, that is called bookkeeping. That is that we used to say it as a journal entries. In bookkeeping system, there are two method of accounting system is there. One is single entry system of single entry system. Another one is double entry system. What is single entry? What is double entry? In petty shops and small businesses, they used to record only cash transaction, and how much they have to pay, how much somebody have to give. Only one some transaction only they may record. It is called as improper accounting system of bookkeeping, right? They do not prepare balance sheet. They do not prepare profit and loss account. They will prepare only what cash comes in, what is to be debit, they have to bring, they have to give to the creditors. Only these things they will maintain. That is called single entry system of bookkeeping. In big organization, it will not reflect the exact profit or loss, or we cannot find out, right? So that is why in big concerns we used to follow double entry system of bookkeeping. What is double entry system of bookkeeping? Double entry means what? The each and every transactions of your business may have two aspects. What are the two aspects? Debit aspect and credit aspect. What is debit? What is credit? Debit means what? What is debit? Credit means what? Anybody?
Debit means what comes in,
Uh,
and credit means what goes out.
both the words comes from Latin word. That is debit means debito, credito. That means benefit. Debit is the benefit. Debito means Latin word. Debito means benefit receiving aspect. Credit is benefit giving aspect. Right. So each and every debit aspect is having equal and corresponding credit aspect. That is called double entry system of bookkeeping. Right. So
In
you have
simple
to
words,
prepare this debit.
in a
You have
simple words, debit means we have to take, or credit means we have to pay.
mm. So I will come to the principal accounting principles here. So this is the accounting principle, golden rule. The transactions which we are going to classify under 3 heads: personal account and impersonal account. Personal account means all the transactions which are in your business events and transactions you have to classify under 3 heads, that is personal account, real account and nominal account. So personal account means those anybody name of the person or company name or anything related to any say for an example banks, name of the bank or organization or anything comes to under personal account, right? Impersonal account under that real account and nominal account. So what are the assets you are purchasing comes to the business, what are the assets goes out from your business comes under real account. Okay, so nominal account, under that you have to debit all the expenses and losses and credit all incomes and gains, right? So personal account is debit the receiver, credit the giver. So you have to debit those who are receiving the benefit, you have to debit it, credit the giver, right? So real account, that is debit what comes in. If you are purchasing furniture, so furniture account you have to debit. So so whatever comes into the business you have to debit it, whatever goes from the business that you have to credit it. Nominal account, under that all the expenses and losses, say for an example wages, salaries, rent, all these things are expenditure. These things you have to debit it and credit all incomes and gains. What are all the incomes? Dividend received, rent received, interest received, commission received. So all these things are income. Income you have to credit, right? And then let us see accounting concepts and conventions. This is the basic accounting rule. Then in addition to that, you have to follow some accounting basic accounting principles and practices, that is called accounting concepts and conventions, right? So accounting principles, that is concepts, what are all the concepts are there? Business entity concept, money measurement concept, going concern concept, cost concept, objectivity, accrual or matching concept, realization concept, periodicity, dual aspect. Accounting conventions are materiality, accounting for conservatism, consistency, accounting for full disclosure, right? So let us come one by one. Business entity concept. Entity means what? Business entity is different from its owner, separated from its owner. Owner's personal transaction should not be bring into the books of business account. Business is separate, owner is separate, right? So in sole proprietary concern, if owner is taking goods from business for his personal use, that is to be treated as drawings, right? So you cannot write his personal expenditure if he is taking cash from business account. Yeah, that should be treated as drawing. We should not take it as business expenditure. Okay, so that is why as per business entity concept, the owner is distinguished from his business activities. Okay. The next one is money measurement concepts. All the transactions which you are recorded in the books of accounts are measured in terms of money or money's worth, right? Then going concern concept. So each and every businesses, when we are starting it, what is the we are going to close within 2 months or 3 months, 6 months, like that? No. So we are going to continue forever. The thought of starting the business continue forever. That is the going concern concept. The business will continue forever. It will not liquidate. So that is called going. We are preparing accounting based on all these concepts, right? Going concern concepts. The next one, cost concept. Based on cost concept, the assets and liabilities which are recorded in the books of accounts as a cost value. So assets what you are purchasing, that value will be shown in the balance sheet, right? You cannot write, say for an example, you are purchasing a van for your business. So now last year you have purchased 20 lakhs. This year it may go up 25 lakhs or 30 lakhs. You should not record in the market value. What you have purchased, cost value only we have to record in the books of accounts. Then objectivity. So objectivity means that is you have to whatever the transactions which you are recording in the books of accounts, you should have some evidences or invoices. If you are making sale, that invoice is the evidence. That is, when you are making auditing, thus some proof should be there. If you are purchasing any machinery, that bill should be provided, right? So all the evidences you have to be collected and you have to produce when you are recording the books of accounts, right? Then accruals or matching concept. So accruals means what? Revenue, sales. When you are making sales, when it is to be recorded in the books of accounts. So when you are when you are recognizing the revenue, that is when it is earned or cash received, or when you are issuing invoices, so that you have to record revenues in the books of account, and it should be matched with the expenses, debit side, right? That is accrual. That is accrual means, for say for an example, accrued but not received. Say for an example, you are deposited money into your bank. Interest is, it may be accrued this month. Every month interest will be accrued, but you might have not received. You may receive at the end of the year or next year, right? But accrued itself, it is treated as an recognition of revenue. Revenue is you have to, revenue is created or revenue is comes, right? Whether you are receiving or not, that is not a matter. Whether is it, if it is accrued, you have to record in the books as income. Okay. Then realization concept, when you have to record your sales into realization. So when you are realizing your assets, or when you are earning the amount, because credit sales, you may not receive money. After 2 months or 3 months only you will receive. So that is also to be treated as sales. You should recognize these sales. So when you are issuing your invoices, sending the goods to your customer, it should be treated as revenue recognition. Sales you should recognize and record in the books of accounts, right? Periodicity. Period of preparing final accounts, it should not too lengthy and it should not too lesser. That is why 12 months period is taken for preparing yearly final statements. Okay. Then dual aspect. Dual aspect, I already told you, debit and credit aspect. Debit aspect is having equal and corresponding credit aspect. That is accounting equation. Under that, assets are equivalent to total capital and liability. These are all accounting concepts. The next one, accounting conventions, that is practices. So what are all the practices? There are 4 types. That is materiality. So materiality means all the informations which you are recorded in the books of accounts should be disclosed in the balance sheet. So you have to disclose it, but at the same time, if you are purchasing pen 10 rupees, paper 5 rupees, eraser 2 rupees, like that, no need to write like that. So if you are writing all these things individually, it will take time consuming, and then it is not practically it is difficult, right? So all these things you have to club into a stationery, right? So that is called materiality. You have to disclose all the informations, but at the same time you have to record all these things into the worthwhile, right? Then if it is a machinery, means big machinery, you can record purchase of machinery, like that. But it's small items you can club into under one heading, right? Accounting for conservatism. Conservatism, which means expected provisions. You are making provisions for bad debts, provision for depreciation. That is the expectation of future losses. You are anticipating the future losses. For that, you have to provide some provisions from your current profit. That is why provision for bad debts. If you are making credit sales, it may be collected or may not be collected. We do not know. So that is treated as bad debts, right? So after some period, you have to write it off bad debts, right? That is why you have to create provision for bad and doubtful debts, provision for depreciation. All these things you have to write. That is called accounting for conservatism. Accounting for consistency. Consistency means there are various methods are there for when you are issuing from stores, when you are purchasing raw materials and giving issue for production, store you have to keep it, right? So there are various methods are there, LIFO method, FIFO method, weighted average method, which price you have to issue for production for consideration of determination of cost, right? There are various methods. If you are following FIFO method, you have to follow FIFO. FIFO means first in first out method. LIFO means last in first out method, like that, right? So depreciation also, for the calculation of depreciation, there are various methods are there. Fixed installment method, the written down value method, all these things. So if you are following one method, the same method you have to follow. If you are keep on changing the method of accounting, that will deviate your profit, differences will come. So you have to be consistently follow the same method. That is called consistency. Next one, disclosure. Disclosure means all the informations you have to give it in the balance sheet annual report. If you see footnote, they may be given. That is which method they have followed. Depreciation, they might have given under straight line method is prepared, under written down value method is prepared. Then stock is valued under LIFO method, FIFO method, like that. So all the informations have to be given in the disclosed in the books of accounts, right? That's all with regards to the accounting principles, accounting principles and practices, right? Accounting. Based upon these principles and practices, you have to prepare the books of accounts. Then next, first one, journal entry. How to record the business transactions in the statement, right? So journal means jor. Jor is a Latin word that means daily transaction. You have to record in the books of accounts. That is called primary set of book. That we can call it as primary set of book. That is called journal. Journal means jor means daily transactions you are recorded in the books of account in the that is called journal, right? See here. Journal specific, like this is this format, date column, particulars column, debit column and credit column. You have to record like this. Transactions will be given like this. This is the business transaction. On 1st April 2016, Mr. Ani started business with rupees 1 lakh and other transactions for the month are is given, right? So 1st April you have to record. 1st April what he is bringing, 1 lakh rupees he is bringing into the business as capital, right, in the form of cash, right? So when you are bringing the cash into for capital, what comes in debit? Debit what comes in? What is the journal entry? Tell me. What is the journal entry? Debit what comes in? What comes in?
Debit what comes in, credit what goes out.
Cash to capital.
Cash to capital. Very good. So here cash comes into the business. So you have to debit the cash account. And who is bringing credit? The giver. Who is giver? Your owner. Owner's capital account, right? So cash account debtor, owner's capital account, 1 lakh rupees. Narration you have to write. What narration means, that is what is the short notes of your transaction. Business started with cash, or that is capital brought into business in the form of cash, like that. Anything you can write, right? So debit column and debit column and credit column, you have to record the same amount. All the debits are equivalent to your credit transaction. That you have to keep it in your mind. Okay, let us see another thing. April 2nd, purchase furniture for cash. Can you tell me the journal entry?
Purchase account to furniture account.
No, you are purchasing furniture.
This account to cash account.
Furniture account data to cash account. Very good. Why we have to record furniture? You have to be very carefully see when you are purchasing goods. That is to be, you have to record purchases account. When you are purchasing assets, you have to record the asset account. So when it is comes into the goods, when it is comes into the business. Say for an example, you are doing wait. You are doing textile business. In textile business, you are purchasing furniture, right? Furniture
Yes, sir.
for other purposes. That is to be treated as
Asset.
asset, right?
Asset.
Asset. Here, textile means when you are a bulk order clothes you are purchasing, no, that is treated as goods. Okay. When you are doing furniture business, furniture you are purchasing from wholesaler for the purpose of sale. That is to be treated as goods, right? So you should be very careful. Goods means when you are purchasing the asset which you are going for sale, purpose of sale, that is called goods. Okay, here you are purchasing furniture. Furniture is the asset. So furniture account data to cash account. What
Cash.
goes out? Cash goes out. Here furniture account data to cash account 7,000 being purchase of furniture in terms of cash, right? Then April 8th, purchase goods for cash rupees 2,000 and for credit 1,000 from college retail store. So what is the journal entry for this? Combined entry is there. You are purchasing cash purchases are also involved. Credit purchases also involved. So when you are making cash purchases, what is the journal entry? When you are making cash purchases, what is the journal entry?
Purchase to cash.
Purchase to cash.
Purchase to cash. Credit purchases.
Credit purchase to
Khalid
cash.
to credit purchase.
Debit the benefit receiver. Who is the benefit receiver? You are purchasing. You are benefit receiver, right? You are purchasing what comes in goods. So purchases account data. Who is the giver? Giver is Khalid
Khalid
Retail
retail
Store.
store.
So you
Khalid
have
retail store.
to credit the Khalid Retail Store. So purchases account, take a combined entry you can write. Total purchases 3,000, right? So purchases account data 3,000. To cash account 1,000 rupees. To Khalid Retail Store 1,000 rupees, right? See here combined entry. Purchases account data totally 3,000. To cash account 2,000. To accounts payable, or we can say it is a accounts payable or creditor or name of the person. If it is given, you write name of the person. Call in the retail store 1,000 rupees. Okay, being goods purchased on both cash and credit, right? The next one, April 14, sold goods to Khan Brothers 12,000 and cash sales 5,000. Can you tell me the journal?
Ma'am, cash to sales.
Cash account data, only cash. Credit sales also there. See here, sold goods to Khan Brother. See here, in your transaction, cash, if they mention it is a cash sale. Without mentioning cash, name of the person, giver name, or when you are making credit sales, receiver name is given, that means credit sales. Okay, credit will not be mentioned. Name of the person, if it is given, that means credit sales. Okay, so you debit the what comes in cash, a cash account 5,000, and you have to debit the receiver account. Who is the receiver? Khan Brother. So cash account data 5,000, Khan Brothers account data 12,000 to sales account. What is your total sales? What is your total sales? 17,000.
17.
See, 17,000. See here, cash account data, bills. We used to say it is accounts receivable or bills receivable or debtor. That is called debtor. Khan Brother is called as debtor. So cash account data, Khan Brothers account data to sales account. Here it is not written. You have to write it like this. When you are making journal, say for an example, cash account, debtor means you have to write dr. We used to write like this. In this statement it is not written. Cash account debtor to sales account. Like this you have to write. Cash account, Khan Brothers account Khan Brothers account. Debtor. Debtor you have to write DR. DR means debitor. Credit means you have to write to sales, right? So cash account is 5,000. 5,000. Credit sales 12,000. So total sales account is 17,000. Like this you have to write. Okay. Like this you have to
I
write.
have doubt.
Yes, ma.
Ma'am, for cash and Khan Brothers, we not to write buy, ma'am. Because these days they
No,
are
no.
writing
Cash
buy.
transaction is totally different, ma. You
No,
are
ma'am.
you are making sales. Khan brother is purchasing from you, right? So he is not giving cash. Cash sales is different. You are selling both cash sales as well as credit sales to Khan brother. Both the transaction you are making. Okay.
Ma'am, no, ma'am. That transaction I can understand, ma'am. But my question is, we should write buy before cash account and Khan Brothers account.
No. Debit what comes in, cash comes in. Debit the receiver. Who is the receiver? Khan brother is receiver. Credit what goes out? Goods goes out. Right? When you are selling goods, goods goes out. So sales account you have to credit. Okay.
Okay, ma'am. That's okay. That's okay, ma'am. But these days they are writing buy in debit. So that I'm asking.
By debita. So when you are making debit sales, you have to write debtor, ma. When you are recording, you have to write debtor. When you are making two sales, like that, you have to write entry, journal entry, right? Cash account debtor, Khan Brothers account debtor to sales account. Let us see next one. Owner withdraw of worth rupees 2,000 for personal use. That is entity concept. Owner is distinguished from your business transaction. What is the entry for this? What goes on?
Drawing account data
Drawings
to
to
cash
cash.
account.
Very good. Drawing account data to cash account. Cash goes out. So you have to credit the cash. So you have to treat the transaction as a drawing. So who is benefit receiver? Owner is the receiver. Owner name you cannot write. That's why you have to write drawings. If he is bringing cash as capital, you have to credit the capital. If he is taking from money from business, that is called drawings. So drawings account data to cash account. Okay. The next one, April 22, paid Khalid retail store. So Khalid retail store, you have purchases, credit purchases on April 8th. April 8th, 1,000 rupees you have make credit purchases, right? So out of that, half of the amount you are going to pay on April 22. When you are paying for your creditor, what is the journal entry? What goes out now?
Cash.
Cash goes
Cash.
out. Who is
Cash.
receiving? Receiver?
Khalid retail store.
Khalid retail.
Khalid.
Khalid retail store account data
Cash to Khalid.
to cash account.
Khalid to cash.
Khalid to cash. Very good. That are accounts payable or creditor, whatever you can say. Name is not given, you have to write creditor. If you are making credit sales, name is not given, you have to treat it as debtor. Okay. Then April 26th received 10,000 from Khan brother. Khan brother, you have made credit sales 12,000. You are collecting on 26th April 10,000. So what is the journal entry?
Cash to Khan
Cash to
brothers.
Khan
Cash
Brothers.
comes in. So cash account data to Khan brothers account. Right. Next April 30th paid salary.
Salaries to cash.
Salaries to cash. Salary is treated as an expenses. So nominal account, debit the nominal account, cash goes out. So you have to credit the cash account. See here, salaries account data to cash account. These are the journal entries you have to prepare. Right? After preparing this journal entry, I have given some other journal entries also. You have to practice. We cannot do many more problems. We have lot of chapters are there. So for example, only one problem I can do. You practice it. If you have any doubt, last class we will discuss. Okay. So after preparing all these journal entries, you have to prepare ledger accounts. Ledger accounts means what? Classifying all the transactions into one account, right? So you have to classify cash account. What is the closing cash balance at the end of the month? So what is the Khan Brothers amount due? What is the amount we have to pay to your creditor? Like that. What is the total purchases? What is the sales? So this is the method of T account. We used to say it is a T account. So debit side, we have to prepare like this. This is a ledger account. Left hand side called debit side. Right hand side called credit side. Left hand side, that is date particulars amount. Debit transactions you have to write in the debit side. Credit transactions you have to write in the credit side. That is date particular amount. Say for an example, one thing. Let us see. See here. This is the journal. Like cash account we are preparing here. Wherever you have written cash, you have to bring it to the debit. If you are making debit cash now, cash account debit side, you have to write owner's equity 1 lakh. That is cash receipt side. Inflow side. Debit side is cash comes in. Credit side, cash goes out. That is debit and credit. Okay. So debit side, what is there? 1 lakh cash. Then purchases to cash. Credit side, buy. Here you have to write buy purchase. Here you have to write two equity. When you are preparing ledger account, here you have to write two. Credit side you have to write buy purchases. Purchases is you have to write 15,000. Then cash debit side sales. Cash sales, that is 25,000. Then accounts receivable, only cash transaction it will enter, right? So buy drawings 4,000. Then commission to commission 2,000. Then 23. This one will not come. Credit transaction you cannot enter in the cash transaction. Then debit side accounts receivable 10,000. So here by salary 1,000. Accounts payable, that is you have paid, cash goes out. So by Ali Sons, that is 8,000. So now at the end of the month, you have to balance you have to close the ledger account. When you are closing, you have to say debit side is exits or credit sides are exits. So total balance, how much in your debit side? It comes 1,37,000. Credit side only 28,000 is there. So that is called, remaining amount is called balance carried down. At the end of the month, 31st July, you have to write balance by balance carried down 1,09,000. Then this is closing balance, closing cash balance you have end of this July 1,09,000. Next month you have to bring it to the opening. The closing balance of the previous month will be the opening balance of next month. Okay, closing balance of previous months will be the opening balance of next month. So opening balance, see here, two you have to write August 1st. To balance brought down 1,09,000. So this account, what you have to treat, is it a debit balance or credit balance? When your balance brought down, opening balance comes which side? Debit side comes, that is called debit balance. Suppose your balance brought down comes to the credit side, that is called credit balance, right? So like this, you have to prepare purchases account, sales account, and then machinery account, drawings account, and then accounts receivable, Rahil store account, Ali account, salary account. Like this, individually you have to prepare all these ledger accounts. Then you have to bring all these balances into the one statement. That is called trial balance. See here. Ledger accounts, I have prepared all these accounts. See here. Purchases account, capital account, cash account, mono account, purchases, furniture, all these things. After preparing these ledger accounts, you have to prepare trial balance. See here, trial balance. This is the trial balance, statement of trial balance. Particular debit column, credit column.
Excuse me.
Ledger balances, you have to see here. All the ledger balances, that is, say for an example, I told debit balance which side? The Sona account, opening balance brought down in the debit side. So debit, this is debit balance. Mini account is credit balance. Furniture account is debit balance. Like that, all these debit balances and credit balances of your ledger accounts bring into this statement called trial balance, right?
Will I get the recording of
Yes.
the session?
Yes. If you are preparing, when you are preparing trial balance, you have to be keep in your mind all the expenses account is debit balances, all the incomes are credit balances, all the assets are debit balances, all the liabilities are credit balances. Okay. These four things you have to keep it in your mind while preparing trial balance. Okay. So try see here, trial balance statements are given in how to prepare statement, right? See here, bank loan. Bank loan is a liability or asset?
Liability.
Liability.
Liability is credit balance. You have to write credit balance. Bank loan, credit side, you have to write, right? Marketable security. That means short-term
Asset.
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 Marketable security is asset. You are investing in some short-term asset. So asset is to be debited, debit. Marketable security, debit. Okay. Bills payable,
Liability.
liability, current liability. So credit, credit.
Please continue.
Somebody has to go on mute. We are getting noise.
Madam, not audible.
Please go on mute, please.
Appa.
Okay. Thank you.
Okay.
Madam, can you explain the drawing?
Explain. Which one?
What is drawing? Drawing.
Drawing means owner taking cash from your business for his personal use. That is called drawings. Cash, goods, whatever he is taking for his personal use from the business, that is treated as drawings. Okay.
Okay, ma'am. Thank you.
Unearned revenue. That means what? Unearned revenue means
Capital.
Outstanding.
outstanding. Very good. He might have received but not accrued. Say for an example, advance, rent advance you may received in advance, but it may accrue for the next month or next year, like that. So that is called unearned revenue or outstanding revenue. So outstanding revenue, what is it, a liability or asset?
Asset.
It's
No.
asset.
Liability. ma'am.
Accrued income is treated as asset. Accrued but not received is treated as asset, income. Okay. When you are received but not accrued, that means liability. Suppose if you have not commission received in advance, if you have not completed that work, you have to repay. That is liability. Okay. So unearned income or outstanding income is treated as liability. You have to write the credit balance, right? Then sundry debtor. Debtor means credit sales, what you have made. That is called asset or liability?
Asset.
Sundry debtor is asset. Sundry creditor is liability. Outstanding salary.
Asset.
Liability.
Liability. That is salary you have to pay expenses, but not it paid. Liable to pay. Okay. Outstanding salary is treated as liability. You have to write debit side. Outstanding salary, liability, that is credit side, right? Outstanding salary. Prepaid rent.
Asset.
Asset.
Asset. Very good. That is whatever you have paid in advance. If you have not yet paid in advance, that cash might be in the business, right? So that is why it is treated as an asset. Then insurance expenses. Expenses you have to debit. Expenses debit, right? Then bonus investment. Investment is credit. Capital you have to credit. Then rent and rates expenses debit. Then accrued depreciation on equipment. Simply depreciation is given, that is called expenditure, you have to write debit. But when you are making provision, accumulated depreciation, you have to write credit, right? Accrued in revenue. Accrued revenue is asset,
Asset.
right? Asset. Asset means the debit. Okay, sorry. Asset means debit. Debit.
Excuse
Asset.
me, ma'am.
Machinery debit.
Asset.
Drawings.
Credit.
Excuse me, ma'am.
Credit.
Credit.
Credit. Equipments asset. You have to
Asset.
debit it. Right?
Hello.
Maintenance expenditure debit. Expenditures you have to debit.
Ma'am, drawings debit.
Drawings is liability, ma.
And why is the prepaid rent treated as a asset?
Which one?
Prepaid rent, why it is treated as an asset?
Prepaid, huh? Why? Because you are paying in advance, right? If say rent paid in advance, if you are not yet paid, that cash will be in your hand, right? That is asset will be in your hand at the day next month when it will be actual expenditure. That one at that time only it will be treated as expenditure. Till that time it is treated as an asset. Prepaid rent or prepaid commission. So all these things are treated as an asset. Okay. See here, machinery is treated as an asset. Drawings, what we do in the liability side, capital, we have to deduct the drawings from that. Otherwise, we have to treat it as a debit balance. Drawings is a debit balance, right? If they would now taken from your business, that it be in your business. So it is to be treated as a debit balance. Then equipment is treated as an asset. You have to write debit balance. Maintenance, all the expenditures are debit balances. And then unexpired insurance. That means what? Prepaid. Prepaid insurance is asset. Unexpired means 1 year you might have paid a premium, but period is not yet completed. So that is called prepaid insurance. That is to be treated as an asset, right? Vendors payable. Payable means liability.
Liability.
That's credit.
Credit. Okay, you can check it. This is the trial balance. After now it has come to end. You have prepared journal, ledger, trial balance. After preparing all these things, you have to prepare final accounts. Each and every business organization at the end of the year, they have to prepare trading, profit and loss account and balance sheet. If it is a manufacturing concern, they have to prepare manufacturing account also. If it is a trading concern, only trading, profit and loss account and balance sheet. I have given explanation everything. Specimens in trading account, how you have to write heading, debit side, credit side, you have to write what are the items to be entered in the trading account. Only that thing you have to take. See here, trading account for the year ending 31st March or 31st December, like that you have to write. Debit side, trading account, you have to write a stock with the opening stock and end with the closing stock, right? So opening stock plus purchases less purchase return or return outward, they have to deduct and enter in the amount in the outer column. Then other direct expenditures you have to write, that is only wages, freight charges, carriage inwards, clearing charges, packing charges. If you are making export, export and import, the dock duties, octroi duty. When you are bringing raw material from your some other country, you have to pay octroi duty. All these things comes under direct expenditure. So direct expenditure you have to write in the trading account. Then credit side, sales less sales return, closing stock, you have to write. Now you have to close this account. You have to see credit side. If it is exceeds your debit side, that is called gross profit. Suppose debit side exceeds your credit side, that is called gross loss, right? Then you have to continue the account, profit and loss account. Profit and loss account, that is, if it is a gross profit, you have to bring it by gross profit brought into account. If it is a gross loss, debit side, you have to bring to gross loss, bring into this account. The other administration, factory expenditure, other expenditures, you have to bring into this profit and loss account. Salaries, rent and rates, stationery, postage, insurance, trading, bank charges, commission, sales and distribution expenditure, office and administration expenditure, all these expenditures comes into the profit and loss account, debit side. The income earned from other businesses, commission received, rent received, discount received, interest received. So all these incomes you have to write in the credit side of profit and loss account. After closing this account, your credit side exceeds your debit side, that is net profit. Your debit side exceeds your credit side, that is called net loss. Okay. After preparing this balance sheet, you have to prepare. In this balance sheet, liability side, left hand side, asset side, you have to write credit side, right? Right hand side. So here you should not say debit side, credit side. It is a liability side, asset side. You should not say debit, credit, because liabilities are credit balances, assets are debit balances. You have to write like this. The balance here, the heading, how you have to write: balance sheet of Mr. Owner of the name, you have to write balance sheet of Mr. X as on 31st December or 31st March 2024. Like that, you have to write the heading. Liabilities, under that you have to classify permanent nature or current nature. If you start with capital, that is the permanent nature. Asset side also you have to start with fixed asset and current asset. Here capital, then current liabilities, right? So if here you have started current liabilities and current assets. Current liabilities, what are they? Sundry, creditor, bills payable, bank overdraft, outstanding expenses. These are all current liabilities. Then long-term loans, long-term mortgage loans, debentures, all these things are long-term loans. Then reserve fund, that is any reserves transferred to general reserve or reserve fund, that is reserves and surpluses. Then capital, in case of sole proprietary concern, closing cap, you have to write how to find out closing capital. Opening capital plus net profit, if it is there, you have to add. If it is a net loss, you have to deduct. If you have drawings, that you have to deduct it. And then if you have income tax paid, that also to be deducted. That is the end capital. Capital at the end, you have to write in the outer column. Here, current assets. What are the current assets? Cash in hand, cash at bank, bills receivable, sundry debtors, short-term investment, and closing stock. These are all comes under current assets. Prepaid expenses is also current asset, right? Then investments. If you have make any investments, and then fixed assets, furniture, fittings, plant and machinery, land and building. These are all fixed assets. Then goodwill, patents. These are all what we can say it is a intangible asset. The fixed asset under that tangible and intangible. Tangible is furniture, fitting, plant and machinery are tangible. Goodwill, patent rights, copyrights, these are all comes under intangible assets, that also to be shown in the asset side. Okay, this is the balance sheet specimen. And then some more adjustments are there. After one statement will be given at the end of the year, the trial balance will be prepared. After preparing the trial balance, some adjustments will be given. So what are all the adjustments that I have given journal entry, how it is to be treated, everything in this PPT. This PPT is available in your website, Pondicherry University DD website. Under that first year, accounting for manager, it is there. You can download and see. Go through this. All these things I wanted to explain, but we have no time to explain all these things. Let us straight away do one problem. How to prepare final accounts with this adjustment, we will understand, right? Generally closing stock, provision for bad and doubtful debts, depreciation, these things will be given in your adjustment. Accrued income, outstanding expenditure, interest on drawings, interest on capital, and then depreciation, that is unearned income. All these things will be given in your adjustment. So how it is to be treated? 15 marks case study. Problem will be given like this. Statement will be given, that is trial balance will be given, and then adjustments will be given. So how to prepare trading profit and loss account? This is the trading profit and loss account for the year ending 31st December 2009, like this. Then balance sheet you have to prepare. Trading profit and loss account and balance sheet you have to prepare with this trial balance and adjustments. Now already time is getting over. Next class you practice it, all these things where it comes. Just next class I will explain you how to prepare this trading profit and loss account, how it should be entered, right? You then after that we will go for a lot of problems are there. We will go one by one. Okay.
Madam, will you be sharing this PPT?
It is already available on our website, DDE website. You go to that. The students see here.
When will be the next class for the accounts?
Next class next week Saturday, Sunday will be there. Okay.
Ma'am, I have a doubt, ma'am.
Yes.
Trial balance drawing is liabilities, and why are they putting
trial balance?
Trial balance drawing is liabilities.
I don't understand what you are asking.
Trial balance drawing is liability. But we are putting in the debit side, why not?
Trial balance drawings is given debit balance. Yes, debit balance. Drawings is debit balance, right? Correct only.
Ma'am, but that is liability.
No, in liability side we should deduct. Capital we have to deduct the drawings. Capital is debit credit balance, ma. Capital is credit balance when bringing the cash into the business owner, that is credit. When he is taking for his personal use, that is debit balance. You have to deduct it. Drawings always debit balance. Capital is always credit balance. Okay. Okay, you practice it. Next class we will do one problem under final accounts. Then depreciation, fund flow, cash flow ratio, marginal costing. So many things are there. We have to rush it. You practice it. Each one heading, I will prepare one problem. Okay. Okay. Next.
What does mean by retained earning, ma'am?
Return
earning.
Return earning.
Retained earning, ma'am.
Retained earnings. Where it is there?
Ma'am, in a book, ma'am.
Retained earnings, that is when you are making credit sales, you are receiving from your debtor, that is retained earnings.
Okay, ma'am. Thanks.
Okay, ma'am. You practice it. Next class you will see. Next teacher is waiting, I think so.
Can you share the PDF?
PPT, it is available on our website.